Thank you all for tuning in. Now, I can't promise you the outcome that you're gonna get from watching this, but what I can tell you, if you apply what you're about to learn, this will change your financial future. If you're here, it's probably because you're ready for change. And what you're gonna learn in tonight's training will do just that. So if taking back control of your money isn't enough to keep you glued to this screen for the next 90 minutes, I think it's time to reassess your priorities. And tonight, we've got a special guest. My good friend Brian is gonna be doing the training, and here's what you can expect to learn. Number one, you're gonna learn how to take back control of your money. And you're gonna do that by learning how to be the bank. Number two, you're gonna learn how to build wealth through your own debts and expenses. And you can do that without working harder, without working longer, and without taking on any additional risk. And number three, you're gonna learn how to get all the money back for every single car you will ever buy, drive, and own. That's exactly what you're gonna learn in tonight's training, so get ready, get set, let's go.
Take back control.
Tuesday night.
Tuesday?
All right. Hey, everybody. Brian Foucher, and welcome to the presentation. One thing, everybody, as we go through this presentation, I know some of you, obviously, we know each other. I recognize you guys' names. You've been here before. But for those of you who are new, by the way, if you're new to this, to the Money Multiplier, or new to this presentation, haven't seen it before, give me a one, give me a Y in that chat box. I want to see how many people we got here for the first time. This is your first time seeing the presentation or seeing this. So Karen, okay, so you're new. Awesome, appreciate that. I'm sure there's quite a few other people here that are new. Feel free to put a one, put a yes. I just want to see how many people we got here that are new to this presentation. So one of the things I want to ask you a question about before we get into the full presentation is, what is it in life that you feel that we should control? Okay. Now use that chat box once again. What are some things that in life that you want to control? There's three main things, by the way, that I'm going to be talking about here that are very important as we go through the slides, as we go through this special presentation. And obviously some of you have seen this before, but yeah, Martin said money right there. Obviously, it's one of the things in life that we do want to control. And it's one of the main things that pops up when we ask that question. What should we control in life? Okay, so money. Now, what's the other thing that we also want to control? Okay, the other thing that we want to control is our time. Now, money can come and go, but time, once it's gone, it's gone. Like, it doesn't come back. We can't get more time. It's also why people will pay you money for your time, because it is the most valuable asset that you have. Other people, employers, obviously recognize that, so they will pay you money for that time. That's trading time for money, right? But if you want to control time, what do you got to control first? Well, typically money. And so for me personally, and you'll see it as I go through this presentation, my thing that I want to control in my own life is time. I want to control time more than anything else. Money, yes, too, but I want to control time. And so some of you have seen me do the same presentation in a motorhome out in the middle of the forest with no internet. I have generator stuff, doing it while I'm traveling with my family. I do it whenever I want, so I control time, right? But there's one thing above all else that you have to control first. And this is one of the things that most people miss, and that is your mind. You've got to control your mindset, because if you don't control what's going on up here, your conscious and subconscious mindset, essentially what we believe in, you can't control money and you can't control time. So as we go through this, I'm going to say this quite a few times, keep an open mind, from what we're talking about. So just keep that open mind. Now, I also want to share with you a quote, and this is one that we at the Money Multiplier, we like this quote because it explains this presentation and this concept perfectly. And it says, the problem in America isn't so much what people don't know, it's what people think they know that just ain't so. Okay. Now, why do I say that? Well, there's a lot of things that we think we know about money, as an example, that we're taught about money that just isn't true. So once again, keep that open mind, because we're going to be challenging the way that you may have been programmed or taught about money. We're going to be challenging that. Okay. Now, think about this. Now, this is a pretty interesting kind of a number here. If you gathered 100 18-year-old kids, essentially, and put them in a room today and asked every single last one of them, where will you be when you're retirement age, like say 65, okay, where will you be? Are they going to say, I'm going to be broke or poor? No, of course not. They're going to say, I'm going to be successful. I'm going to be a millionaire, maybe a billionaire, whatever. I'm going to be wildly successful. Now, here's the fact though. If you fast forward to when they are actually at retirement age, The fact is only 5 out of 100 of those 18-year-olds will be financially secure in retirement age. 5 out of 100. So that's crazy. Knowing that we're in North America, one of the wealthiest places in the world, yet only 5 out of 100 people at retirement age will be financially secure. That kind of blows my mind. So let me ask you a question. Who here wants to be one of those 5? Do you want to be one of the 5 or one of the 95? Give me one of the chat box. Give me a 1, give me a Y, give me something in the chat box if you want to be one of those 5 people and not one of the 95. Because if you are here in this presentation, obviously you want to be one of the 5 or 5% out of those 100 that is financially secure. Okay. Yeah. Dallas said, yeah, 5 right there. Anybody else? And because you guys want to be one of the 95, or do you want to be one of the 5%, right? Well, of course we want to be one of the 5%, right? We want to be that. And so here's the thing though. This is not something that I just made up. Okay. Yeah. Danny, Kenneth. Yeah. We want to be one of the 5%. This actually comes from the Social Security Administration that 5 out of 100 people will be financially secure at retirement age. Like this is the fact. And that's kind of creepy. And and I'm, by the way, I'm not even talking financially free, like wealthy. I'm just saying secure, right? And so secure is fine, but we want to be financially independent. We want to be financially free. So yeah, there you go. So this is what this presentation is about, is how to become one of those 5. Now, most of you don't know who I am, so a little bit about me. I'm going to go through this pretty quick though. So I did go to college. I did that traditional path, so to speak. Got a degree from Washington State University. Go Cougs! I know there's someone from Seattle. So, but I got that degree. I have not touched that degree, by the way, in over 10 years. But that's what I did because that's what I thought I was supposed to do. And I call that journey that I went on the hard way. Okay. What's the hard way? Well, I was raised, lower class, lower income. I remember when I was young, we had to go and stoke the fire in the morning to get the house warm because we didn't want to turn on the heat because it was too expensive, that kind of stuff. But had a great upbringing, great family. But I was taught to follow that traditional path in life, right? Go to school, get good grades, all that kind of stuff. Get a job, which I did, right? Had a 401k, was pushing money into that 401k because that's what I was told to do by my employer, right? That's what you do. I had that house with the white picket fence, right? I had the growing family, all of that kind of stuff. And I had what everybody told me was the American dream. Now, it didn't feel like an American dream to me. It felt like the American nightmare, to be honest. But here's the thing. Where did the American dream come from? Now, this is a whole separate presentation I can do, but it came from banks, by the way, home ownership back in the 50s. That was the American dream, home ownership. So that's what I did, and had that mortgage. I had the cars. I had all that kind of stuff, and I was drowning in debt. And I remember seeing this magazine at a doctor's office and I remember I picked it up. It was a financial magazine, and it said, hey, the average millionaire knows their net worth. And I realized, well, I don't know mine, and I know I'm not a millionaire, so I wonder what my net worth is. So that actually is the piece of paper. I since lost it. It got destroyed in a flood. But that was the paper. I took a picture of it because I was worth a negative amount of money after 10 years in an industry, and I was making almost 6 figures per year, but I was worth a negative amount of money, and it got worse as I went forward. And so I was like, what the heck is going on? This makes no sense. And then I had an event happen in my life. And this was my grandfather. So my grandfather was my idol. Like, when you grow up, you have those people you look up to, maybe it's a family. That was my grandfather. And he was a renowned person in my community because he was the local baseball coach, and I think it was football coach as well at the local high school where my dad went, where my brother went to high school at. And everybody knew him. And so it was pretty cool growing up, and everybody respected him, and he worked really hard, and he was working harder and harder to actually have a really cool retirement. He had this big plan, going to buy a motorhome, travel around, do all this cool stuff after he retired. And he worked into his 60s and then finally retired. And he bought the motorhome with his wife, my grandmother, and they started to travel, did it for about a year and a half. And then he got really sick. He had Parkinson's, he went on dialysis, kidney failure, a bunch of other things, and ended up not being able to even leave the house for the last 3 years of his life, and then he passed away. He never really got to live that dream that he had for retirement, and that really kind of punched me in the gut. I didn't know what to do, but I knew I had to do something different. Okay, and so that's what I did. So that actually kicked me off. Years later, I started learning how money really worked. I started learning how banks work, all that kind of stuff. Ended up becoming an entrepreneur. So I left my career in construction, became an entrepreneur. I actually raised capital for some investment funds. This was this business right here that's on the screen because anybody can say anything on the internet. So this is one of my businesses. This one was I started in 2016. It did over $2 million in COVID, by the way, made the Inc. 5000 list. And it taught financial literacy. And I used Robert Kiyosaki, his personal advisors, as the content creators, that are people I know. So I started having success and had some big lessons learned, but that led me to learning about infinite banking, which is what we're going to be talking about today. And so that's led me to do a lot of things, and I control my time. That's my big thing. So as you can tell, I love classic cars, by the way, and I love experiences. I love to go out and have new things with my family. We've traveled in our motorhome for 5 weeks at a time. Those are my cars on the left-hand side, bottom there. But I love to have experiences, and through that, I learned about infinite banking and started teaching that to other people. So this is me at one of a high-level mastermind teaching people about this concept for very high net worth individuals. So that's essentially my journey into this space. Now, that all being said, who else is doing this? So what I'm going to be talking about here, infinite banking, the infinite banking concept, or IBC, it's not a new concept, by the way. It's been around for a couple hundred years. It's been around for a long time. And so who else is talking about this? Okay. Well, as I mentioned, I actually learned it from one of Robert Kiyosaki's advisors. Well, they actually was one of my mentors. So he talks about this concept in his book, Second Chance. I do recommend that book, by the way. Tony Robbins, I've been to quite a few of his events, by the way, Business Mastery and Unleash the Power. He talks about it in his book, Money Master the Game. It's a great book, by the way. Then, of course, this one right here, and I always have my copy sitting next to me. I have more than one of these. But Becoming Your Own Banker, Unlock the Infinite Banking Concept by R. Nelson Nash. You'll hear Nelson Nash quite a bit. He's the one that popularized the concept and made it mainstream. And then one of my mentors as well is Brent Kessler and Chris Naugle. They have the book Mapping Out the Millionaire Mystery. And Chris also has the Private Money Guide. By the way, if you guys want those two bottom books as PDFs, there's going to be a link here a little bit later where you can actually click it and get those books and some other resources via PDF. And if you guys, and I'll put my email address in there too. You can always email me directly if you want to get those as well. But yeah, so we'll do that. All right. Now, who else has used this strategy throughout history? So Jim Harbaugh, I think I'm pronouncing his name correctly. I never know, but he was actually paid because he was one of the top, paid coaches. He was compensated through the infinite banking concept, and there's a reason why. I'm not going to get into why on this, but yeah, he was paid through this concept. This gentleman right here, he probably doesn't remember his name, but his name is Joe Biden, currently the president. So he actually has 4 of these policies. He had to disclose them when he became the president, and I wonder why he has these. You'll find out why. Disneyland. So this is pretty cool. So Walt Disney, he started Disneyland, way back in, I think it was the 30s, but he couldn't get bank financing to start up Disneyland. And so he used this concept to self-fund starting Disneyland. So if this concept didn't exist, Walt Disney may not have been able to start Disneyland, may not exist. Kind of cool. Also, so Ray Kroc, so when he was taking over or expanding McDonald's, he used this concept to fund the business for salaries, for cash flow during the first 7 to 8 years of this McDonald's. And so without this concept, McDonald's as we know it might not exist. It's kind of cool. The Pampered Chef, she used some money from one of her policies to start the Pampered Chef, which I think Warren Buffett got for 1.5 billion. So a pretty good return right there. And then a lot of wealthy families use this concept. So think of the JPs, the Morgans, the Chases, the Vanderbilts, the Rockefellers. They've all been using this for generations, and now you can use it as well. Now, what will infinite banking do for you? So let's talk about what it can accomplish and help you do in your life. So day one, it creates guaranteed generational wealth. It's actually day one, not year 30, not year 10, but day one, you have guaranteed tax-free, by the way, generational wealth. That's pretty cool right there. It allows your money to grow uninterrupted, compounded for the rest of your life with guarantees. I love guarantees, by the way. And this one is really important. And you're going to see some of this as we go through the presentation. But uninterrupted compound interest is, it's probably one of the 8th wonders of the world or something like that. It is so powerful, and you're going to see how powerful it can be as we go through this. It also takes control of your money away from the big banks and Wall Street and puts the control into your hands. So remember at the beginning when I talked about what do we want to control? Money is one of those big things. This concept allows you to take back control, put it back into your hands. It protects your money. So protection, of course, part of having that control is protection. So it protects your money from lawsuits, from bankruptcy, from divorce, in creditors in most states, by the way. Now, very importantly, it allows you to be the bank for things that you may normally use a bank for. So think of like banking functions such as investing into real estate, college, cars, homes, investments, even retirement planning. But you're doing that while still having all of the benefits listed above. It's not one or the other, it's all at the same time. That's what makes this thing so cool, because most concepts or strategies, it's one or the other, right? It's or, right? This is and, do this and this and this and that at the same time. So that's why infinite banking is so powerful. Now, give me a one, give me a Y, give me a yes, something in the chat box if you guys want to have all of these things working for you in your life. Would that help you build wealth? Would it help you do more within life, right? So give me a one, give me a yes in that chat box. There we go. Richard, okay, yeah, there you go. Anthony says, yep, you know it, absolutely. So, I mean, and this is, by the way, is not all of the things that it does. It's not all of them. It's just some of the things that it does do, which is very cool. All right, and we're going to go through these things and how they look and how they work and how you can use them. All right, now, as I said before, you don't need to take out a pen and paper, of course, but if you guys want to take notes, I do recommend it. If you have questions that maybe come up after the fact, or maybe we don't get to them, and you want to ask me directly after the presentation, write them down, but also use that chat box, use the Q&A box. As I said, I will be answering questions as we go through this. Now, I'm going to share this really quickly. This is called the backwards bicycle. Now, really quickly, who learns fast? Well, think about it. Kids do. Kids learn really fast. Now, remember when you learned to ride a bicycle? Now, I remember when I first rode my bicycle. I remember when I first got up on the pedals and was going, right? But once you learn how to ride a bicycle, it's kind of hard to forget about it, right? Like maybe it's 10 years down the road, you hop on a bicycle, you'll pick it up pretty quick. Now, what if though, now picture this, what if the bike did not operate the way that it normally does? Meaning that you jump on the bike, and this is the backwards bicycle, by the way, and you turn the handlebars to the left and the bike goes to the right, right? And there's a video, Google it after this if you want, it's called the backwards bicycle. It's pretty funny. The guy falls over right off the bat, right? Because you go to the left and the tire goes the opposite direction. It's pretty crazy. Now, it takes him I think it was 6 weeks or something like that, quite a while to learn, or maybe it's 6 months, to learn how to ride the backwards bicycle. Now, once he learned how to ride the backwards bicycle, what do you think happened when he went to ride a regular bicycle? He fell over, right? So he could not go back to the regular bicycle because his mind wasn't thinking that way. He had to learn how to re-ride the regular one. So money is the same way. So we are taught a certain way to think about money. Okay. But really, money works a different way. And that's the backwards bicycle analogy. So once you learn how to ride the backwards bicycle, or once you learn how money really works, it's very hard to go back to the regular way of thinking about money or the regular bicycle. So once again, keep an open mind. Now, what we're going to be talking about with the infinite banking concept is changing one very important thing when it comes to money. And that's where your money goes first. Okay. So now let's kind of talk real quickly about why more people are not successful. These are the mysteries around money. So just think about these things. So what are some wealth killers when it comes to money? Taxes, right? And I always say this, I don't mind paying taxes, but I'm a lot happier paying a lot less, right? So that's why we like this concept. It allows you to pay less. Inflation. Now, by the way, inflation is not rising prices. We think that's what it is because that's what we're told. But inflation, by the way, is inflating of the money supply. There's two causes of that. I won't get into it in depth, but the first cause is the Federal Reserve printing money. The second is fractional reserve banking. Okay. So inflation is bad. We don't like it. But with infinite banking, you can take your money out of that situation and get more control of it. Okay. Volatility. Okay. Volatility up and down, up and down. That's called interrupting your returns, or interrupting your compounding, right? So we don't like volatility. We want to remove that from our lives or from our money. Interest, of course, interest going out to other people is what I'm talking about. Interest to other people means that you take $1, pay it in interest, and you never get it back. Opportunity cost is what's that called, by the way. Mindset also, following the status quo, fear, FOMO, right? Life in general, creates our mindset that is not maybe, serving us the best way that it should. And then what we're taught when we're young about money and things like that may not be serving us when we're older. So that's why we want to keep that open mind. Anonymous attendees had a question here. Do you know the going rate of a HELOC now? Depends, but right now between 8 and 9% from what our clients are getting there. So for a HELOC. All right. So what's the definition of money? All it is a means of exchange. It could be a dollar bill. It could be seashells. It's just a means of exchange. That's all it is. Now, what company uses compound interest? Do banks use compound interest? No, they don't. They charge you interest, but they don't use it themselves. Because if you write your name on a $20 bill, gave that bill to a teller, will they put it into a box with your name on it in the back room? No, they don't. That bill goes into motion, right? They put that money into motion. So there's not a business that uses compound interest in the way that we're going to be talking about it. Now, are your dollars worth more today or in the future? Think about that. They're worth more today than they are down the road, right? Because if you have a dollar bill today, how many candy bars will it buy today versus 20 years down the road? Or how many candy bars would a dollar bill purchase you 20 years ago, right? So your money is worth more today than it is down the road. Do taxes go up or down? Obviously, they're going to go up, right? Now, knowing that, let's say you're a farmer and you have seed, okay? Would you rather pay taxes on the seed, right? Or on the harvest down the road? Which one would you rather pay taxes on? Okay. Think about that. Pay it on the seed, right? Then you plant the seed and now you have the harvest down the road. Which one do you want to pay taxes on it? The seed, right? You want to pay taxes on the seed, get the taxes out of the way, and then your crop or your money is going to grow tax-free. Okay. So you want to pay it on that. But here's the thing, think of like an IRA or 401k, by the way. So an IRA, a 401k, those kinds of things, you're giving up dollars today for weaker dollars down the road. Also, remember paying taxes on the seed or the harvest? With a 401k, you're paying taxes on the harvest, not the seed. Okay, right? So you've got to understand that. So I'd rather pay it on the seed than the harvest because the harvest is going to be bigger, and I don't control what they're going to charge me down the road. Okay, so you're going to pay taxes on a larger amount down the road. Okay, all right. Now, here's another question. Would you wait to eat bread or milk? Like that's a kind of a strange question, but like think of it this way. Would you go buy a loaf of bread, put it into the freezer, and then 5 years down the road, there's 2 loaves of bread, and then you'd eat them down the road? Well, no, you wouldn't do that because one, they'd be 5 years old, they'd be freezer burned, wouldn't be very good. Yeah, I got 2, but that's not, well, that's kind of gross, right? Or another example is this. Would you go buy a car or a house and then park the car in the garage for 5 years, or not live in the house for 5 years and then live in the house 5 years down the road, or then drive the car 5 years down the road like a Honda Accord? Of course you would. You're going to buy it now and drive it today. Okay. So what we want you to do to think of this way is you want to use your good dollars today. Okay. So use your good dollars today and then pay back, that with weaker dollars in the future. So really what you want to do is use your dollars today. Okay. We've been trained to do the opposite, by the way. The opposite. And then, so think about that. So what do you know about your retirement account? Okay. Same thing, right? Right. Same thing I just explained. You're putting your dollars into a 401k and then you're going to use it down the road. It'll be weaker dollars and you're paying taxes on it. So that's kind of crazy right there. And also, obviously, of course, in like a 401k, those kind of things, you don't control what they're doing. You don't have control of what the returns you're going to get, that kind of stuff. So once again, control. Now, I know I just threw a bunch of stuff at you, but I'm just trying to get your mind thinking a bit differently. That's the purpose of this, okay? Because up until this point, probably just like me years ago, I was taught to just accept that traditional way of, trading time for money, thinking about money, spending money, right? And to build truly, generational wealth, we need to challenge those ways of thinking, those old ways of thinking about money, okay? Now, let's talk about how your money flows. Now, this is going to get into the infinite banking concept a bit here. So let's look at how money flows on a traditional transaction like buying a car. Most of us have bought a car before, right? So let's say we're going to go buy a car for, let's just say $25,000, right? Doesn't matter if it's 25,000 or 50,000 or what kind of car it is. Now, let's also say that you happen to have $25,000 in a bank. Okay. So once again, you're going to go buy a car for $25,000, but you have cash of $25,000 sitting in the bank. And that maybe let's just say that bank is paying you 4% on that $25,000. Okay. That's a pretty good bank, right? Let's say they're going to give you that 4%. Now you come to the bank and you say, hey, Mr. Banker, I want to take that $25,000 out of the bank that's earning 4%, by the way, and I want to pay cash for the car. Okay. Now, what if the banker says, well, wait, don't do that. Don't do that. Instead of you taking the money out of the bank, leave it in the bank, earning 4%, and I'll give you a loan of $25,000 with the cash as the collateral, and I'll give you that loan at 6% simple interest. Okay. So we're going to do a 5-year note on this. So let's look at what that looks like. Okay. So the bank's going to give you a $25,000 loan, 6% for 60 months, 5 years. And then you're going to have the cash in the bank earning 4% for 60 months or 5 years. Okay. So what's that look like as far as the flow of money and how it affects you as far as your wealth goes? The monthly payment is going to be $483 on the car note. Now, the money in the bank is going to be earning 4%, so 4 and 6%. The future value of the car payments is $28,999, call it $29,000. Now, what's the money in the bank doing though? Well, the future value of that money is $30,525. So, in reality, you've made $1,526 earning 4% while paying 6%. Now, most people would look at that and say, well, Brian, that's a negative spread, a negative 2%. But you've got to understand, why is this happening? So you've got to understand the banking transactions, the banking functions that are happening here. The 4% is earning compound, okay? And it's earning compound on top of interest. So that's going to earn you more, because on the other side, the car note at 6% is simple interest. You're going to be accruing 6% on a smaller balance every month. So you're actually going to pay less than 6% while earning 4%. So you're going to make money. Does that make sense? So this is a banking function right here. Now, most people don't do this. Most people will just go and get the loan on the car, not have the 25,000 earning 4%. But with infinite banking, we're going to be showing how to do all of these things at the same time. Okay. All right. So here's what we're going to be covering today, which is the money multiplier method. So the first thing is going to be the machine. We're going to cover the machine. Okay. The next thing is the marathon, because this is not a sprint, it is a marathon. When it comes to building wealth, right, it's the marathon method. But then, of course, the last thing is the millionaire. How do we use this concept to really build wealth, build generational wealth, become that millionaire in our lives, okay? So let's go ahead and dive into the machine. Now, the machine is this. It's essentially nothing more than a dividend-paying, permanent whole life insurance policy, specially designed with a mutual insurance company. So think of infinite banking concept like a car. It has tires, brakes, a radio, mirrors, all that kind of stuff. But what makes the car, infinite banking, the car go down the road? It has to have an engine. So think of this dividend-paying whole life policy, specially designed, as the engine that makes the car go. Gary said gas. Yes, of course, it needs gas. Yep. And then the gas is, I guess, Gary, a good analogy there would be when you fund your bank, when you capitalize your account, that is the gas. I like that, actually. That's a good one. But yeah, so you might be thinking, well, Brian, what life insurance? I don't, do I need life insurance, or that doesn't make any sense? It's for death benefits, all that kind of stuff. So here's the thing. This is a very different way of thinking about these kinds of vehicles. So we're going to go through that. Now, the second thing I want to make sure you understand here is, well, who uses this? Who uses these kinds of things? Because, why would I want to use it? Well, it's banks. So banks, by the way, own more whole life insurance than they do their real estate and buildings combined. So if banks are taking your money in and basically doing this concept, let's just bypass the banks, right? Because they're doing this with your money. And gee, do you think they maybe know something that most people don't know about money? Absolutely. So we're going to bypass the banks. And if you don't believe me, go Google bank-owned life insurance, or BOLI, and you can look it up. Yeah, so they own a lot of this kind of stuff, actually. And they actually quadrupled their holdings since 2016, by the way, of these kinds of assets. All right. So once again, I just showed you how you can make money earning 4% while paying 6%. Okay. Now, the difference with infinite banking is that when you do the same transaction, you're the one in control on both sides of the equation. In most cases, the bank is in control because they own the loan on you, okay? In this scenario with infinite banking, you're going to be in charge or in control of both sides of it, borrowing and lending. When you do that, that's how you start to build wealth and gain back control, okay? So let's go through this and see what it looks like. Now, before we get into the infinite banking part of it, we need to understand how a bank functions. Because what is a bank doing with your money? So let's kind of go through what a bank does with money. So let's just say that you put $100,000 on deposit with your local bank. It doesn't matter if it's a credit union, or a big bank, it doesn't really matter. And let's say they're going to pay you 4%. So when a bank does that, they have a liability. They owe you that $100,000 and the 4%. That's a liability on their balance sheet. But does the bank just sit there and look at your money? Absolutely not. They loan it out. So they loan it on maybe it's a home mortgage, something like that, maybe a HELOC at 7%. That's an asset on their balance sheet, by the way. But what's the home seller do? Well, they don't just sit on that cash either. They put it back into the bank. Okay. Does the bank sit on that money? Absolutely not. They create another asset. Maybe it's a car note. What's the dealer do? Puts the money back into the bank. What's the bank do? Puts it right back out into circulation again. Maybe it's on a home remodel, something like that. Maybe a construction thing. But what does the contractor do? What do the subcontractors do with the money? They put it right back into the bank again. But once again, the bank puts that money into motion. So maybe it's on debt consolidation, credit card companies put it right back into the bank again. So what you're seeing here is the bank is always putting money into motion, right? Like we put our money and let it sit there, but the bank doesn't do that. They put it into circulation. That's how they make a lot of money. And by doing that, they're making 500% more than they're paying you. Okay. So they're making a lot more money off of your money. Now, if you don't believe me, by the way, go to bauerfinancial.com. You can see that banks make between 400 and 1,300% on the money that you leave inside your account with them. That's what they're doing with your money. And you can go back in history and look and see how much they made throughout history. I mean, there is typically not a time where they haven't made a lot of money on your money. Now, I'm not talking about what they do with like mortgages and the things they do that got them in trouble. I'm just talking about when you put money with them, what do they do with it? They put it into motion. Okay. And so with infinite banking, we're doing the same thing. We want our money in motion, making us money or gaining back control of the transactions in our lives. Okay. Now, to understand how infinite banking can work, let's understand the annual pattern of spending. Now, when I first learned this, it kind of made me a little sick. So just bear with me as we go through this. So let's look at how we spend our money, how our money goes out of our hands. So for every dollar that comes into your hands, into your, your account, your checking account, whatever it is, 20 cents of every dollar goes to automobiles. Okay. Next up, 30 cents of every dollar goes to housing. Think of like, rent, mortgage, stuff like that. 40 cents of every dollar goes to travel, goes to entertainment, food, everything else, right? Now, if you look at that, that's 90 cents right there, okay? 90 cents of every dollar that comes into your hands goes right back out to somebody else. Opportunity cost right there, okay? Now, 10% goes into savings. Now, a few years ago, the savings rate in the US was about 5 or 6%. I don't think it's even 10% right now. I would be shocked if it is with inflation, all that kind of stuff going on. I don't think it's that high, but 10 cents of every dollar goes to savings. Now, when you go talk to like a financial planner, by the way, what do you think they talk about? They don't talk about your automobiles, your housing, or everything else. They talk to you about your savings. Oh, let's maximize the savings. Let's put into a high risk category so it can grow faster. That's what they talk about. We don't want to take on any more risk. In fact, we want to remove volatility, remove risk from our money, because that does not help us build wealth. You can do it if you want, if you're in control, but in most cases, that really destroys wealth. So let's look at the opposite. Okay. So let's look at how do we actually take the money that we're paying to somebody else, interest, by the way, and put it back into savings. So as I said, 20 cents of every dollar that we make goes to cars, and I'm talking like fuel, tires, payments on the loans, etc. But of that 20 cents, 5 cents of it is interest. 5 cents of the 20 cents to cars is interest. Let's take that 5% and put it back in the savings, because now we're in control, and we'll show you what that looks like. Okay. Of housing, it's really it's worse, because of that 30 cents that goes to housing, roughly 25 cents of that goes to interest. That's an amortized mortgage, by the way. So it goes interest. So let's recapture that 25 cents and put it back into savings. Now, as I said, 40 cents of every dollar goes to everything else. Now, there's not a lot of interest tied to that. It's about 5 cents of every 40 cents of everything else goes to interest. So let's take that 5% and put it back into savings. Okay. So what you're looking at here is when you start to gain back control of your money and the banking functions in your life, you can actually benefit, because it's going to help you save more, build more, or build more wealth. That makes sense? So we're just changing mainly one thing, that's where your money goes first, but also gaining back control of these functions in your life. So let's go through an example of what this looks like. Now, as I said, I am a car guy, so there you go. I love cars. So what we're going to show you right now is how to get all the money back for every car that you'll ever buy, drive, and own. Okay, and it doesn't matter if it's a Mustang or I actually have a '67 Mercury Cougar right now, or if it's a Honda Accord or a Ferrari. It doesn't really matter. But let's look at how this how this will flow. So let's look under the hood of infinite banking. Okay. Now, this is what's called a policy over here, a policy illustration. It's just a summary of one of these. Now, what you're going to see when it comes to life insurance, we think of premiums, we think of a bill or an expense. But I want to change your mindset around that because when you have infinite banking, it's different. You have what's called a premium deposit. Why do I say deposit? Because when you deposit this into your policy, you accumulate what's called cash value that you can then borrow out. So you're making a deposit into your bank that then you can then leverage and use. So we call these premium deposits. Okay. So I'm going to change the name, the way that that works. All right. Next up, age. So a lot of people say, well, Brian, I'm 68 years old. I'm 75 years old. I'm 55 years old. Can I still do this? Yes, you can. So age, does it change things? Yes, it can. But these are very, very versatile strategies. So age doesn't matter. If you're, 80 years old, can you do this? Yes, you can. You can do it on other people, by the way. Infinite banking can be done on other people where you're the one that uses the bank functions, but you're the owner and somebody else is the insured. So we'll go through that in a bit more. So once again, age doesn't matter. Death benefit. So when people think of life insurance, they think, oh my gosh, death benefit. Well, that's a benefit after the fact. We want to talk about living benefits, not death benefits. Now, we will talk about the death benefit a little bit later on, but that's not the focus of infinite banking. It is the living benefits of this concept, all right? Okay, so let's go ahead and look at how this will function when you buy a car, okay? So let's assume we're going to do a $10,000 per year deposit, premium deposit into a policy, okay? We're going to do that for 7 years, all right? Now, you're going to have what's called cash value inside this policy, which allows you to be the bank. Now, let's say year 3, you're going to borrow $25,000 from your bank, and you're going to treat your bank like you would any other bank. So what's that mean? It means that you're going to pay back that loan back to your banking policy. Let's just say it's going to be $500 per month, $6,000 per year for 5 years. Okay, so that's what it looks like. So you're going to see the deposits of $10,000, the car purchase of 25, and then the car loan payments back to your own banking policy of 6,000 per year. So what's the math on this look like? You put in 70, that's the deposits. You've also paid back $30,000 over 5 years. So that's $100,000 you put towards your infinite banking policy. But you also had $25,000 of cash that you took out. Now, by the way, that could have been used to buy a car like I showed you, or it could have been used for real estate, for investing, for anything else, but we're using the car as an example. So in reality, you've put in $75,000 into this policy. Now, you've also recaptured 91 cents of every dollar you've put into this policy. So you've actually recaptured that money. It's actually still working for you. So keep in mind that if you just paid $25,000 for the car, that money is gone. It's never coming back. And that's called opportunity cost. Yep. Yeah. And then Danny said, my death is profitable for everyone except me. That is true, but that's called generational wealth. But with infinite banking, you can use your death benefit while still alive. That's the whole purpose here. Now, let's go to the second set of years. Okay. Gary says, sign me up. Yep, absolutely. So the second set of years, this is where it really gets, it gets just, it's just cool. Okay. So let's say that you don't put in any other deposits. Now you can do this, by the way. So this person in this example puts no more premium deposits into their policy. Now you can if you want to, which we do recommend, but this person does not. Yet, guess what they do? They still go purchase another car in year 8 because the cash value is always growing, always going up. Even though they stop putting money in, the cash value is still going up. You can see it over there on the right-hand side. It's always going up, which is amazing. Okay. So you purchase a car for $25,000 and do the same thing. You pay that back to your policy the same as you would any other bank. 6,000 per year, 500 per month. So now what is the math? Well, the car payments were $30,000, yet you took $25,000 out to buy the car. So how much did you put into the policy in those second set of years, year 8 through 12? You put in $5,000, but the cash value, the amount you can borrow against, went up by $23,592. So is that a good cash on cash return? $5,000 gets you 23,000 and change of growth. Absolutely. But here's what's even more crazy. So if you look at the math here, how much has gone into the policy? How much have you put in? Okay. So you put in $80,000. Okay. $80,000. And yet the cash value is $91,000. And you own 2 cars. So your wealth has gone up. You still have all that access to all that money and more, by the way, and you own 2 cars outright. So if you think about that for a second, if you just bought the cars with cash, you'd be negative $50,000. With infinite banking, you're actually own the 2 cars and you're positive 91,000. Okay. Actually, and you put in 80. So you own the 2 cars and your wealth has gone up by, let's say, 11,000 and change, if you want to look at it that way. So that's how it works. Okay, so that's how you can use this to buy your cars and actually build wealth at the exact same time. So when it comes to infinite banking, there's 3 rules that we talk about. One is pay yourself first. And really what that means is that we've always been trained to, $10 comes in and guess what? We pay this bill, this bill, this bill, and then $1 is left over and that is ours. So we pay everybody else first and ourselves last. We want to flip that script. Pay ourselves first and then everybody else. Pay yourself with interest. Okay, so if you're going to be the bank, treat yourself like a bank. Pay yourself with interest and then recycle and recapture your money. What that means is that instead of just letting it go out the door to somebody else, recycle it through the policy first, capture that money, and then go do the banking transactions or functions. Okay. All right. If this works for a car, what else does it work for? So the other really common thing that we see that clients want to use infinite banking for is things like debts, because debts are one of those things in life that really just steals wealth away. And we get into that perpetual wealth cycle, right? You buy a car, pay it off, guy to get another car with another loan, etc., right? So how do we get out of that perpetual debt cycle? So let's look at an example of how infinite banking can do that for you. So in this example, this is a 45-year-old male. He's got 9 third-party debts. He is $478,000 and change in debt. Okay, it's a lot. That's a lot of money right there. Total payments going out are $5,777 per month or $69,000 per year. Now, how long would it take this person to pay off these debts? If they just did it traditionally, by the way, 19 years. 19 years, a long time. So let's see how we can do this in 7 years and save us a lot of money. Okay, this is a pretty cool example, and this is based on a real case study. Some of the numbers are obviously not exact on it, but this is how this can work, and we've done this for hundreds and hundreds of people. Okay, so year 1. Okay, so start an infinite banking policy. So this person starts a policy. They're going to put in $25,000 into this policy. So money they're put into savings, they're going to put into the policy now. So it's $25,000 in annual premium right there. The cash value immediately available within 30 days is $14,863. Now that's being very conservative, by the way. In reality, it's usually a lot more than that, but I want to be very conservative. So that person has access to 14,000 and change right off the bat. So what do? We borrow that from the policy, from our own bank policy, and we pay off the Discover card, we pay off the Lowe's card, and part of the Nordstrom card. Now here's what happens. Okay. So your monthly payment drops by $448. So you've recaptured that cash flow essentially, okay? Now, what do you do with that cash flow, that $448? You don't just let it go out the door, you recapture it back into your policy or back into a separate account. So here's what it looks like. So in year 2, you put in another $25,000, that's your premium deposit. That gets you cash value within 30 days of $16,571. Also, the $448 payments back to yourself equals $5,374. So the total cash you have is $21,945 available. So what do? We borrow that back out. We pay off the Nordstrom card, Wells Fargo, private loan, and part of the BMW. Okay. So now the monthly payment changes. It now goes down by $1,917. Okay. Your total debts have been reduced to $378,000. Okay. Now what happens? Year 3, same thing. Okay. Repeat the process. Okay. Another 25,000 goes in. Cash value jumps up by 25,000 and change. And the payments of $1,917 back to your own account equal $23,004. Total cash is 48,000 and change. Same thing happens again. We take that money back out. We pay off the BMW, West Marine, and part of the condo. Now our debts are only 283,000. The monthly payment has dropped by $3,677. We're only in year 3, by the way, the beginning of year 3. Okay, so that's what's happening right now. So you see how this is accelerating quicker and quicker. Now, before I go to year 4, really quick, how much did we put into this policy for this client? We put in $75,000. Okay, how much have we taken out? Roughly $55,000. So how much is left in the policy? Okay, how much is left inside this policy? So some people will say, well, it's going to be $20,000 because you put in 75, took out 55. But in reality, the way the infinite banking works is not $20,000. It's $75,000 still inside the policy, earning you, by the way, uninterrupted dividends. Okay, you're compounding at the exact same time. You have 55,000 outside of it working for you as well, paying off these debts or whatever else you want. So it's not one or the other. You actually have the 75K working for you, and you have the money outside of it. And Danny said, yeah, 75K, exactly right. And that really right there is where you got to start to think differently about how this works. Okay, so let's go to year 4. Okay, year 4, same thing. 25 goes in, cash value goes up by $26,304. Now keep this in mind. He put in 25,000, but the cash value grew by more than he put in. That's pretty powerful right there. The payments of $3,677 back to your own account equals 44,000 and change. So the total cash available is $70,439. Okay. Now, Gary said here, do you have to continue with the 25K years 4 through 7? I recommend up to 7 years. So we'll get into that in a little bit later. I'll show you what it looks like, but I typically recommend max funding for 7 years. And then after that, you can drop it down if you want to. But once you see the numbers, you will not want to stop. You'll want to keep doing it because it's going to accelerate faster and faster and faster. Okay. Now, what happens in year 4? So we pay off a big chunk of the condo. We take that $70,000 out and pay off the condo. Now, what happens is a bit different in year 4 because the condo and the house are amortized mortgages or payments. When you pay down the principal, the payments do not change. Okay, they don't change. Okay, so now let's go to year 5. Now in year 5, same thing happens again. Another 25 goes in, cash value goes up by 27,000 and change. Payments back to yourself are 44,000 and change. Total cash $71,225. Now you pay off the entire condo and a big chunk of the house. Okay, your payments per month have dropped down by $4,556. So it's gone down a lot. Okay, the only thing left, by the way, is the house payment. Now, in this year, it's going to be a bit different. In year 6, we're going to do something a bit different. We're going to start a second policy. Now, here's the fun thing with infinite banking. You can have multiple policies, not just one. You can have multiple ones, have them on other family members, whoever you want. Now, why would you want to do that? Well, because now you have more cash flow, maybe income has gone up, net worth and, salary has gone up. You want to do a second policy. Okay. And by the way, I think it's like 70% of our clients do a second policy. So now you drop the first policy from 25,000 per year down to 10,000. Okay, so you'll see it right there. The 10,000 goes in year 6 on the first policy. Cash value goes up by $13,092. So once again, it's growing by more than you're putting in. So Gary, for your question, like if you're gonna put in 10,000 and get 13,000 back out, would you want to put in the 13? There you go. On the second policy, we put in 25,000 premium deposit, and the cash value available on that one is $14,863. And the payments back to ourselves from the $4,556, that is 54,000 and change. So the total cash available is $82,633. Okay. Now what do? We wipe out the house. Our debt's now 0. Our cash flow per month is $5,777 that we now have coming back. What do we do in year 7? In year 7, we take that $5,777 and we put it back into the remaining policy loan, pay that off. We are now debt-free. Our cash flow has gone up, and we have a policy with 6 figures of cash value that now we can use to do whatever we want. Buy a car, go on vacation, invest into real estate, create more cash flow, whatever you want. So we are in control of all of that money, and it has not left our hands. So we paid off the debts, but we remained in control of the money. Okay. So we didn't lose that opportunity cost. Now, if you're saying, well, Brian, that sounds really cool, but I have no clue how to do what you just talked about. Don't worry about it, by the way. So these are things that we have solved in our own lives. So we have built software and tools that we use with you, our clients. So this is called the Debt Blaster, by the way. It actually maps out what I just showed you. Like I couldn't tell you how to flow the money and all that kind of stuff. So we have tools that in software, there's no cost, there's no fees, nothing like that on these ones for people we're working with. But yeah, we show you exactly how it works, how long it'll take, how much you'll save. We even compare debt payoff to things like velocity banking, snowball method, those kind of things. Infinite banking, by the way, almost always beats those things. It does very well. So that's what we do for people. So think of it like this. So think of it like your personal financial be your own bank blueprint. We actually have a team called the mapping team that helps you do these kind of things and work these things out in your life. And there's no cost, no fee to that kind of stuff. So, but yeah, so that's just one of the things that you can do with this. Now let's kind of talk about the next step, which is the millionaire method. Okay. So what if I have no bad debts? Now this comes up quite a bit. Okay. What if I have no bad debts? Or what if I don't need a new car? Okay. Can I still benefit from privatized banking? Should I still become my own banker? Absolutely. The answer is yes, because once you do those things, pay off the debts, don't need a new car, that's where the fun begins. That's where you start to build wealth and create that legacy. Okay. So we're going to go ahead and get into that here in just a moment. But let's see here. I said, Danny said, it looks like fiat money. Well, it's not. So I mean, fiat money is fiat money. I mean, that's just dollars, whatever kind of currency you want. It's fiat currency. Now, when it comes to infinite banking, it doesn't matter if you're dealing with fiat currency or seashells. It's just whatever we use to transact and means of exchange, I guess I would say. So that makes sense. So everything has to equate back to whatever the current money is. Right now, it's currently dollar bills. It could be, yen at some point down the road. Who knows? Buck. So there's a question here. It says normally the theory is when you free up a payment, you should pay that into the policy, then borrow it back out to use. In this scenario, you're taking the money payment freed up and putting it into a separate account to pay off debts. Why is that? Great question, Buck. So you can do either one. So it's just up to you. So the way that I explain it is it just goes into a separate account. I would recommend putting it back into your policy loan so that you're reducing the interest on that loan and then borrow it back out. So you're correct. You caught that. That's good catch right there, by the way. Danny said, yeah, I mean, yeah. So that's the way I look at it is fiat currency is just whatever the government is saying is the means of exchange. It doesn't matter to me if it's yen, if it's seashells, if it's coins, if it's bottle caps or dollar bills. The insurance company will use whatever is available. That's the way I look at it. I wish it wasn't a dollar bill sometimes, to be honest. All right. So let's talk about creating wealth now in multiple ways. Now that we've paid off these debts, we've recaptured that money, what can you use infinite banking for? Active real estate investors. So think wholesalers, flippers, buy and holds. I got my start in real estate, by the way. I did subject to as a strategy. So I've done that kind of stuff. We have a lot of real estate clients, commercial property. So think like apartments, mobile homes, things like that. Private funds, passive real estate, so lending. So we have the Private Money Club, by the way. It's a private group where people lend and borrow money back and forth, and you can use infinite banking for that. Business owners. So if you're going to go into business or have a business, think of infinite banking like a business line of credit. It's a revolving line of credit, by the way. So a lot of people will use this as hey, I want to take some of my business revenue. I want to put it aside for down the road because, hey, I'm self-employed, but I'm not saving for the future. This is a kind of a forced savings account, if you want to look at it that way. But at the same time, you can use it as your line of credit. So think of like if you're a business owner and you have like maybe it's an IRA or a solo 401k, that money goes in there and you don't see it again. With this one, you put inside the account, but then you can borrow and use it without losing the growth. So for business owners, this is a very attractive strategy. We do have some stocks and options traders that are, do that full time that use this to put their money in two places. Startups. So we got some startup companies, people that they have like a large amount of capital to fund their business, but they don't want to lose that money and just dump it into the business and not have access to it. So it goes through the policy first, then into the business. They still have control of the money and it's still growing for them. Equipment flipping. So this is kind of a funny one. So we actually do this. So we have people like my colleagues and stuff that are doing equipment flipping with their policies. And that's just buying a piece of equipment, renovating it, and then selling it. Okay.
You ever feel like you don't have control of your real estate business or your money? That's right. The big banks and the institutions, they're in control, right? I know you felt that before. Private Money Club puts you back in the driver's seat. As members often tell us, it's a total game changer. Join the community of like-minded lenders and borrowers by going to privatemoneyclub.com and sign up.
Now, what I want to show you is now let's get into some real life examples of what these things look like and what the numbers look like. So this is an example of using your private bank, infinite banking, for private money lending. So think of like when you're going to do a real estate deal, if you're going to do like a flip, maybe you go to a hard money lender that lends to you at 12%. But what if you are your own bank? Let's see what that looks like. So this is what's called a policy illustration. And what you're going to see here is you're going to see these numbers. So we're going to look at the net cash value over here, and we're going to look at contract premiums over here. So in this scenario, this person is putting in $50,000 per year. You'll see that right there. Additionally, optionally, they're going to put in $100,000 upfront as well. That's an optional thing. It's called a dump-in. I'll explain more about that here in a moment. But they put in $150,000 day one. And now these are end of year numbers, by the way, but at the end of the first year, they have access to $132,000. But let's look at what this policy does over time. So let's go to year 8 as an example. So in year 8, you have $66,000 of growth in the policy. Okay, so the cash value available for you to borrow against went up by $66,000. Yet, how much did you put in? Okay, so it grew by $66,000, but you only put in $48,594. So once again, what am I saying here? You put in $48,000, it went up by $66,000. So that's a pretty good cash on cash return. In fact, that's a 37% cash on cash return in year 8. And by the way, that's a positive cash on cash in years 3, 4, 5, 6, 7, and 8. And it'll never go down. It actually keeps going up, by the way. Now, what would it look like if we private lend this money? Here's what it looks like. So let's say that you borrow from that pool of money, okay? So let's say you lend it at 12%, okay? You private lend the money at 12%. You're already earning 37% on that money. You're going to pay yourself back at 5%. That's the rate of that loan. So your cash on cash return is 44%. So 44%, that's the return there. So we did nothing different except where the money went first. It went into infinite banking, and then we're leveraging that money into other things without losing the growth. What do I mean by that? So let's say in year 8, you borrowed $531,000 out of this policy to private lend and get that cash on cash return. None of these numbers change. You still get the exact same growth, the same return, the same benefits. Everything is the same, except you have that money in your hands. So that's what's changing here. So in this example, would you rather make 12% private lending or 44%? Kind of a no-brainer, but be your own bank, right? That's what this allows you to do. And this is just one example, by the way, but I want you to see some of the numbers, and we're going to go through some more things. Now, how is this possible? It's uninterrupted compound interest. So remember when I said that person in that example is borrowing that money? Well, it does not affect the dividends or the return they're getting on their policy. So you're leveraging that money into other things without losing growth. And so this is what it can look like. So in this example, this person puts in $50,000 lump sum upfront, which is optional. They're putting in around $5,895 per year, or $491 per month. You can do monthly or annually. Okay. So the cash available day one is $51,000 and change. But look at what the numbers are down the road. Yeah, Danny says I like looking at numbers. Yeah, we're gonna show some other numbers. I'm gonna show some other examples and stuff too. So in year 5, you have a 26% cash on cash return. Access to capital is 126%, which means you have access to more money than you put in. Year 15, it's 115% cash on cash, 115%, by the way. That's a lot. 215% access to capital. And you'll just see that at year 20, year 25, year 30, it just gets better and better and better. 30 years down the road, 386% cash on cash return, 486 access to capital. Okay. So that's where the compounding really starts to take effect, is within the first set of years. Okay. So there you go. That's why that compound is such a big deal. Now, one thing I want to stress here is this: how do you eat an elephant, right? We all know the answer. It's one bite at a time. The other thing I like to explain is, the man at the top of the mountain didn't just fall there. Okay. What do I mean by that? When you see that person on the pedestal, or they're on the top of the mountain, they didn't just land there in most cases. They took that first step. Okay. And they eventually got to the top of the mountain. Infinite banking is the same thing. Like once you start that thing rolling, it gets better and better and better. And pretty soon you'll find yourself at the top of that mountain. But it just takes that first initial step. Okay. Just want to make sure that we stress that. So the machine works for debts and expenses, vacations, homes, taxes, everything else. But what else does it work for? So before I get into that, I want to explain one thing really quickly. Remember the homes we looked at when it came to the doctor, the 45-year-old doctor that had all those, or chiropractor, had all those debts. But let's look at the house and the condo. Now, I want to stress these because when you look at a house and a condo, when it comes to like traditional financing, we look at mortgages. So what can infinite banking do to kind of flip this around a bit? So let's just assume that we pay these things back as promised back to the traditional banks. Okay, the condo is going to cost $220,000. The house $273,000. That's $493,000. Okay, now what if we actually use our infinite banking to recapture this money? Okay, so if we make these payments back to ourselves essentially at 4% interest. Now, by the way, the rate is, it's actually higher than that we're earning on the money. Okay, but let's just assume 4% for this example. We're going to actually pay ourselves back and have access to $749,000. Now, if you don't know what I'm talking about, don't worry about it. But here's what I want to explain. You can either pay 493 over the course of 224 months or 251 months, or accumulate $749,000 of wealth and own the house and the condo. That's a swing, by the way, of 7 figures. So 30,000 foot level, just understand that when you start to understand how banking works and how you could get control of it, you can go from paying $449,000 to having $749,000. Okay. Excuse me. Now, if you don't know how the numbers work on what I just said, I'm going to tell you that I don't know either, but our software does. So this, by the way, is called the gain projector. So if you have like an investment or a real estate deal or something like that, and you want to say, okay, I want to see how the policy would work for that deal or that investment, we have software that you can use that will show you exactly how to do it and show you what the numbers will look like. Okay. All right. So real quickly, Ken, I got your question here. I'll answer that in just a second. So here's the thing. So when I think about this concept, I wish my parents had known about this and set me up with this. But guess what? They didn't know about it, but you do and I do. So guess what I set it up on? Myself and my kids. Okay? Because if you don't, you're stealing wealth, generational wealth from your kids and your grandkids. And so it's really cool when you see how the numbers can work for the next generation. So by the way, guys, so the next step, if you guys want to hop on a call with me personally and go through how this can look or work for you, you go to brian.beyourownbanker.com//TBCT. I'm going to go ahead and put that into the chat box as well right now. And by the way, the resources, like I talked about, the PDFs of those books that are on that link. So click that link and you should be able to get those books there once you book the call. Or if you want, I'm going to put in my email address and you guys can just reach out to me via email as well. Now, I do have more slides, by the way, guys. This is not the end of this. I do have some more examples and some scenarios, and I'm going to break down infinite banking a bit more as to how it works and some of the different things that are inside of it. But Ken, to answer your question, how much can you start with? So I'm going to get into that, by the way. Yeah, I mean, the 25K per year was just an example. Keep in mind that was a high income person with a lot of debt. I mean, over $500,000 of debt. So keep that in mind. But yeah, it's your numbers, by the way. That was just their numbers. So keep that in mind. But typically the minimum we recommend to start is 10 times your age per month. 50 years old, 500. 30 years old, 300. That's like the minimum to recommend, or recommend is to get your start, but I'll go through that here in just a moment. So one thing I want to kind of mention too, that is this picture. I love this picture. I don't know why, but it just makes me laugh. But I was always the guy at the bottom, and maybe you are right now, working for our money. And so the whole concept of infinite banking is getting your money working for you, but with control, without the volatility of the markets, removing those things, having more control. So that's really kind of the switch that we're making. All right, Linda said, if this is set up on a 25-year-old, do they take blood, urine, and physicals? Good question. So it depends on the 25-year-old, but right now with some of the companies, no, they don't. In most cases, there is a medical exam that the insurance company orders. You don't pay for it, there's no cost, but it's blood, urine, and questions. It's not really a physical per se, but yeah, if you're in your 20s, oftentimes they're being waived. Yeah, so you don't have to do them. All right, so here's some things that we want to talk about that as part of infinite banking. So one, the death benefit. I am going to talk about that because there is something to that. The loans, We're going to talk about the loans, because the loans, by the way, do not have to be repaid. Now, we do recommend paying them back because you want to be a responsible banker, but they don't have to be repaid. The internal values grow tax-free. So as I said, I don't mind paying taxes, but I love paying less a lot more. Okay. They're exempt from judgments and liens in most states. That means they're a protected asset. And you can create tax-free income in retirement, right? I love tax-free. Okay. So let's talk about the death benefit. So in this scenario, in this one over here, what you're seeing is a 42-year-old female, okay, over here. She's putting in $20,000 per year premium deposits. Now, what you're going to see over here is the death benefit of $325,416 day one. But what you're going to notice is this. That death benefit is going up year over year over year. It's going up. It's always increasing. Okay. Now that death benefit, as I said, is guaranteed tax-free to be passed on at some point down the road. Hopefully a long time down the road, because it's going to get bigger and bigger, but it's guaranteed tax-free. That's generational wealth. So why do you think wealthy people do this on all of their family members? Because they know that at some point they're going to get that money coming back. So keep this in mind. So this person, by the way, if you look at cumulative premiums, in year 5 has put in $100,000 into this policy. The cash value is $483,000, more than 4 times what she's put in. So think about that for a second. From generational wealth, from a wealthy person's perspective, if they can put in 100 grand and know that it's going to get turned into significantly more guaranteed down the road, why wouldn't you want to do this, right? So that's why and by the way, I learned it from some very wealthy individuals. That's why they do it, because they know they can create that generational wealth. Okay. All right. So that's how the death benefit can work. Now let's talk about the policy loan. So when you're borrowing from your own policy, you are the one in control. So a couple things: the policy loans are guaranteed. Like they're guaranteed. If you have cash value, you're guaranteed that loan. Okay. There's no credit check. There's no approval. Basically, ask and you shall receive. The loans are private. Okay. They do not go on your credit report. So think about that. Remember that the chiropractor that were paying off his debts? So when he paid off those debts and moved them into the policy and then paid it all off in year 7, what also was happening behind the scenes is that when they pay off those debts, those credit debts, they come off of his credit report, right? So they come off your credit report. These loans, by the way, they don't go on your credit report. Okay. There's no minimum or maximum payments on the loans. You choose the payment schedule. Now I walk you through how to do those, or my team does, but there's no minimum or maximum payments because you are the one in control. So think of like a car loan. When you go get a car loan from a car company or a bank or credit union and you don't make the payment on that car loan, what do? They come take back the car. They repossess it. But guess what? If you are your own bank and you can't make the payment that month, don't make the payment. That's fine. Nothing's going to happen. Okay. As I said, miss a payment, nothing happens. So it's putting the control back into your hands. That's the whole purpose of this. Yeah. Now, next question I get quite a bit is, how can I fund my banks? Ken, I think you asked that question. How can you fund the bank? Okay. Well, here's how you do it. So you can do it monthly, you can do it quarterly, you can do it annual. That's up to you. And you can change that during the policy life, by the way. The minimum that we recommend to fund the policy is 10 times your age per month. So as I said, if you're 25 years old, Linda mentioned that, 250 per month. If you're 45 years old, 450 per month. That's the minimum recommended. The maximum is going to depend upon your gross revenue or gross income. It's usually between 15 to 30% of that. So 25% of your gross income or revenue is a good number to look at as the maximum per year divided by 12 for monthly, right? Okay, so on top of the premium deposit, you can fund the policy with a large dump-in. We call it a dump-in. You saw it in those previous examples. I'll show another one, but it's called a dump-in or a lump sum that you do upfront at the beginning, and that really funds the cash value. Okay, so it gets over 90% the cash value usually within the first 30 days by doing that. Okay, now as you fund the policy in the early years, anywhere from 50 to 90% goes to cash value within 30 days. Depends on the structure of the policy. I walk you through all that kind of stuff. But as the policy gets more mature, 3, 5, 10 years, you're going to have 100, 150, 200% going to cash value every time you put money towards the policy. So they get very, very, very efficient. It's pretty cool. And so the question to ask yourself is, would you want something like this where you can put in $1 and get $3 back out? Like that's kind of the question. Now, let me show you exactly what I'm talking about when I say that. All right. So, and Linda, I see your question there as well. I'm going to cover that one here in a second. So on this one, this is once again a female, age 32, putting in 10,000 premium per year and a 50,000 lump sum upfront. Okay. So day one, 60,000 goes in year one. And by the way, she could do monthly. She's just doing annually on this example. Cash value at the end of the first year is 55,000 and change. That's a very, very good cash on cash return right there. But here's the thing. What's it look like in year two? This person puts in $10,000, gets more than 10,000 of growth out of the policy, $10,607. Year 10, or sorry, year 11, puts in $3,120 and gets $10,590 of cash value increase or growth out of the policy. See how the thing is getting very efficient down the road? That's the compound that comes into effect. And if you look at these numbers, I'm not going to go through all the numbers on here, but this policy is getting more and more efficient every single year, all the way through the entire policy life. Okay. So these things are very, very powerful. All right. Now, this is Warren Buffett's quote, and I'll share it. And it says that if poor people would just do what rich people do, they wouldn't be poor anymore. Now, I don't quite buy that quote. I don't like that quote all that much. My quote's more like this. If poor people knew what the rich were doing and had that access to that knowledge, they wouldn't be poor anymore. Now, why do I say that? It's because not everybody can do infinite banking. And I'm very clear about that. I'm very honest with that. It's not a fit for everybody. Okay. But if it is, it can be a very powerful way for you to build wealth in your life. Okay. Now, and then Linda, I think the next slide is the one you're talking about, which is IULs. I'll talk about that here in just a moment. Now, why should I work with you, Brian? I get that question quite a bit. So just really quickly. So I've been teaching infinite banking for probably 8 years now, or 9 years, I think. So we have an entire team that works with you and sets up infinite banking. So we are one of the largest, if not the largest producer of infinite banking in the US. So we have a full team. We just do infinite banking. We all use it in our own lives. We are all entrepreneurs. We're all investors. I own a golf ball business. I own a financial literacy business. I own a marketing business. I do other things, but infinite banking is part of my life. Okay. I currently have over 100 clients in underwriting right now. We have over, I think, 800, 900 within our entire group. We provide ongoing support and services during and after you have a policy, and we don't charge you anything for that. There's no cost to you, no fees, nothing like that. But we give you ongoing support, because if you're going to have infinite banking in your life, you have to know how to use it. We want to make sure that you know how to use it, and that's what we do. Once again, no cost to that. Okay. Next up, IUL or VULs, variable universal life, which is what Linda is asking. So correct, Linda, these are done with whole life insurance, not IULs. So no, we do not use indexed universal life or VULs or ULs or anything like that. We only do whole life insurance policy, specially designed for infinite banking. IULs and term insurance, buy term, invest the rest. We've all heard that. Pay some of the highest commissions out there. Okay. And if you go talk to somebody about IULs or something like that, or a whole life policy, and they say, yes, we can do infinite banking, but there's no cash value in the first year, run away. That's not infinite banking, by the way. Okay. It's not infinite banking. We also take about a 70% cut in commission to do infinite banking. Okay. And we only do infinite banking. Another thing about IULs. So at the core of infinite banking, okay, at the core of it is gaining back control of your money, removing our money from that volatile system, or the fiat system, right, which is the Federal Reserve printing money, getting our money out of that broken system and back into our hands. So by that definition right there of what we want to do with our money, which is getting it away from the markets, away from the uncertainty, away from volatility, we would not want to use an IUL because they are tied to the markets. By their definition, they are the opposite of what we want infinite banking to do for us in our lives. Okay. Anthony said, what they also do not say with IUL is the accumulation phase and cost. Yes, exactly. Yes, there's a lot of things they don't say about those things, or they don't disclose. And unfortunately, I have calls, not every day, but almost every other day, where I'm having to explain to somebody what their IUL is, because they were not told by the agent that set it up what it really was and what it was doing for them or not doing for them. That's why we're doing this presentation, by the way, to show you guys how these things work, to give you that knowledge and information. Because unfortunately, I come across a lot of people and clients that have been sold something else and were not told how it works or functions, and it does not work like they thought it would. So, not to bash it too much, but that's a horse that we have beaten to death many, many times. All right. All right, so real quick, some last couple slides here. So one of two things happen to us in life, right? We live, are we better off with or without infinite banking? Better off with it, of course. We also die, right? It's part of life right now, or part of life. And so are we better off with or without this? Well, as you saw from some of the things, the benefits, obviously we're all better off with this in our lives, okay? So this is kind of something I share because I've been doing a lot of marketing before. I've done a lot of presentations like this, but I see a lot of people, but they all kind of fit into two groups. It's a tale of two people, as I call it. Group one is that used to be me, by the way, not that picture, but like I always told myself, I don't need anything, I don't need any help, I don't want to learn anything new. I'm going to keep working, 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 working. And unfortunately, that did not turn out very well for me because I ended up losing lots of money, putting my money with bad characters, things like that. And whenever I heard something new, I just ignored it. Okay. But I don't want to be in that group. I'm in group two now. And group two is really where when I learn something new or I hear something new, I hear, hey, this is what so and so is doing, or this is what this group is doing. I want to learn about what's going on. I want to see what's going on behind the scenes. I want to say, hey, if wealth is being transferred, which by the way, it is happening right now, wealth is going to be transferred very fast, very soon. Which side do I want to be on? Like I'm always asking that question now because in this one, I was on the losing side. When wealth was transferred, it was transferred away from me. Group two is where we want to be because wealth is transferred to that group. When you learn something new, as an example, do you take action on it? Do you learn how it works? And so for me, like I've always said, I want to be in that group two now. Doesn't mean I'm going to do the concept, but I want to learn more about it. And so, like as an example, cryptocurrency, right? I learned about it, I played with it, but I don't touch it because I don't know about it, and it's just not interesting to me at this point in my life. But with infinite banking, when I learned about it, I knew something was different, and I learned all about it. I actually was flying around to advisors' offices in other parts of the country just to learn about infinite banking, and it has transformed my life. So that's the group that I always want to be in. So here's what I recommend. If you want to learn more about infinite banking, if you have some questions about it, or if you want to see how it's a fit for you, just schedule a call with me. There's no obligation. There's nothing to buy. There's no pitch. There's no sales pitch. Nothing like that. It's just you and I having a call, talking about what infinite banking is, what it can do for you, going through the numbers, seeing what it can look like, that kind of stuff. So that's the presentation, guys. Obviously, I'm going to leave it with this quote here, which is the problem in America isn't so much what people don't know, right? It's what people think they know that just ain't so. I love that quote just because, man, I've seen so many people's minds just open up to what really is going on behind the scenes and how they can change their lives, change their wealth just by understanding how like this thing can work for you. So yeah, thanks, Anthony. Appreciate that. Yeah, yeah. Thanks, Brendan. Appreciate that. Let me go ahead and put my information here. Yeah, if you guys want to email me, feel free to email me as well, or you can schedule a call. It's up to you. There's my email address. It's brian@chrisnaugle.com. Yeah, so Chris and I work together, obviously. Alexander, yeah, you go ahead and use that link right there. And if there's no times available, there should be times. I'm in the process of moving, by the way. So I'm actually moving to northern Idaho. I think we're finally moving the end of next week. So I'm driving quite a bit, but yeah. Let me know if there's not a time available. I can always open up some times on the weekends too. I'm always available. Yeah. But yeah, any questions? Any last minute questions? Anybody? Linda, I hope that answered your question about the IULs. And by the way, so this is something that some people don't know about. I'll just share it just from general information. So if you have an IUL or another type of policy and you're not sure if it's working or if you're not sure if it's set up correctly or whatever, let me know. I actually look at other policies and I can tell you what it looks like. Reach out to me and I'll review it with you and help you understand it. And then if it's not efficient, it's not really serving you, you can always do what's called a 1035 exchange. I would only recommend those if the policy is not working for you and is not doing what you want to do. You can always 1035 it over into a whole life policy, the cash value. You can move it over with no consequences. Yeah. So there are options sometimes if you have that. Alexander, who does the calls? I do. So we have a team of, do the calls, but that link there is directly to me. So it's that you'd be talking personally with me one-on-one. Carrie, I was put in an IUL years ago thinking I was getting into this. They were so wrong. Yeah, it's unfortunate. That's a very common story where someone sold an IUL and it just does not perform like they thought it would. And by the way, we're saying this from personal experience. We're not just saying it to bash IULs. Chris has IUL because he, like Carrie, he was sold on IULs when he first heard about infinite banking and ignored, his mentor, and then found out, oh my gosh, these are not what I thought they were. He still has them to this day, and he actually will compare his IULs to a whole life policy. And obviously, what the end result is, the whole life does a lot better. So yeah, and also if there is a Nelson Nash Institute that certifies infinite banking practitioners like me, and they do not even allow you to touch IULs. Yeah, because they have created so much damage for people. Yeah, so great question or great comment there, Carrie. Said I even asked the company about using it, this way, and they seem to think I've lost my mind. So that if you call up the insurance companies directly and try to do this, they might not know how to do it. And by the way, it doesn't matter if you go to us or straight to an insurance company or another person. It's the same cost, by the way. There's no cost. That's it, because there's no cost. So it's really the same. But yeah, so we actually work with multiple companies, by the way. We're not entitled to one company. We will look at the individual, you, and say, okay, what is the best company? What is the best, the best product for the client? And then we will marry you up with that. So that's what we do. That's what I do. Yeah, so we're not going to just stick you with one company that's not a fit for you. Brenda, so you can switch an IUL over using 1035 exchange. Yes, you can. Now, does it always make sense to do that? No, it doesn't always make sense. But I will tell you that. Like if it doesn't make sense, I am legally bound to tell you that if it makes sense or not. I won't tell you to do a 1035 if it doesn't make sense. So just got to keep that in mind. But yeah, it oftentimes it does, depends on how long the policy has been there, because IULs have fees, they have surrender charges, all these things that make them not very attractive to some people, and they don't know that they're even in there. So yeah, so we do look at those. Yeah, Ken, yeah, for sure, absolutely. I don't think we got any more questions, but as I said, yeah, if you guys have a question after the fact, always feel free to text me or email me. We can hop on a quick call and go through whatever you got. All right. So unless we got any last minute questions, we will call it a day. But yeah, look forward to talking to some of you guys on the phone, whether it's here this week, next week, or whenever you guys are ready. All right. Well, have a great rest of your week, everybody. Stay safe. And oh yeah, thank you. Yeah, Van. So Christy Van. Yep, absolutely. Yeah, fantastic. Yep. Yeah. So by the way, so we are very affiliated with a lot of other people in this space. So yeah, so we've come across. We know Christy very well. Yeah, she's awesome. And that's infinite. That's a velocity banking for everybody else. That's what she's talking about. All right, everybody, take care. We'll talk soon.
All right, so I hope you guys enjoyed that episode. We're putting up tons of them, but I think if you like this one, you'll probably like that video as well. Not only that, I've got a book that I created, Mapping Out the Millionaire Mystery, where we actually show you what the wealthy do in the game they play with money. I want you to have that for free. And if you want to know about all my new videos coming up, click that alert button. Actually, smash that alert button, and you'll be notified every time we put a new video. So we'll see you on the next episode.